Yo, good morning, everybody. It's Curtis back with another portfolio update. Before I begin, please smash that subscribe button and help me get to 500 subscribers. I try to get to it by the end of this month, but it is a stretch target. I always set stretch objectives and goals. But obviously getting anywhere near the 400 mark is just as good. So please subscribe to the channel. Please like the video, and also feel free to comment if you've got any questions on anything I mentioned in this video or any questions about investing in general. Please get in the comments. As you will see, I always reply as soon as possible with the best information I possibly can. Now, I know some of you guys have been waiting for another portfolio update. The last one was the 12th of April, so just over 2 weeks ago. You know, I'm trying to make sure that my channel is as diversified as my portfolio. So I want to make sure that I do give you the portfolio updates as regularly as I possibly can when there's good information to share with you, but also give you other investing content and information so that you guys can, you know, benefit from that as well. But let's get into it. My portfolio update for today. So a lot to cover off today. So let's get cracking. First of all, I'm going to talk about US stocks. So as you know, my last purchase, my last portfolio update, I mentioned how I bought 2 US stocks, being Verizon and First Solar. I was really impressed with First Solar. Now, I was actually up 25% on First Solar, and I'd only bought 1 share, which was really disappointing. But obviously, I was trying to be a little bit cautious. It was my first 2 US stocks. As you can see, it's now 6.53%. This is just because I've bought a further couple of shares yesterday, which has obviously diluted the profit down. So I was up, as you can see from this graph, 25%. So I was really impressed with the performance over the last month. As you can see, it's just trended upwards consistently. So I do have high hopes. It still looks undervalued from my analysis as well. So I think there's a lot more growth to come in the future. Verizon has been sort of marginally underperforming. Hasn't been underperforming terribly. As you can see, it's just 3.51% in the red, but still, because 5G hasn't been released, I'm still waiting for that. I think the 5G release will trigger growth with the Verizon stock. So it's potentially a buying opportunity. I'll just dollar cost average it as I normally do. Now, I mentioned in yesterday's video and a previous video that I've added 2 new ETFs. So that's the iShares S&P 500 and Robo Global from Legal and General. So I'm often asked why I chose iShares over Vanguard S&P 500. You know, for me personally, there's not really that much of a difference. It's really minimal. I could have eeny, meeny, miny, mowed it, if I'm honest, to be honest. But I didn't eeny, meeny, miny, mow it, nor should you. But the rationale for me basically choosing the iShares S&P 500 was just because their last year's performance was slightly better than Vanguard. That was literally it. The dividend is exactly the same. 3-year return is exactly the same. The only thing is the share price is slightly less, so it looks like you've got more shares, but in terms of your actual return from a dividend standpoint, it'll be the same. So the expense ratio, the cost, both 0.07. So again, there's really not much difference currently. Not to say that won't change in the future, depending on how well they track the performance of the S&P 500. But yeah, I chose the iShares, and so far so good. I only bought it yesterday, so obviously still very early days. Robo Global has been performing well recently. Now, obviously, I only bought it yesterday. As you can see, it's been trending upwards quite considerably. So there's a little bit of curve, as you can see. These graphs are a little bit meaningless, but there's a little bit of curve. So I do anticipate Robo Global will go into the red probably for the next couple of weeks, just because it's been trending up really well. So I might have bought at a semi-high point, but I personally believe that that, you know, it's a very long-term play for me. As I mentioned, there was an article from Bloomberg that it's estimated that half of the world's jobs will be replaced by robots in the next 10 years. I'm not excited about iRobot happening in real life, but I am excited about the potential of a long-term return. It returned 81% in the last 3 years, this specific ETF. So hopefully I could be looking at a few 100% in the next sort of 10 years. So I think Robo Global is still a fantastic buying opportunity if you're looking at it for the super long term. And so yeah, even if it drops, I'll just use that as a buying opportunity to really buy more stocks, really. Now onto my UK stocks. I have been overexposed into banking. So as I mentioned in the previous video, I think 30% of my portfolio previously, before the US stocks and before the ETFs, was pure banking stocks. They're all in the green, which is good. So I've got Barclays, CYBG and Lloyds, so 4.44%, 9.45% and 2.51%. They've been consistent, to be honest. But they're not looking undervalued anymore when I do my analysis. So I didn't really want to add too much. Also, I only added £20 to each bank yesterday when I did my normal round of investing, which is obviously a very small amount, considering it's really just that's 80% reduction in what I would normally put on average to a specific stock. I wanted to reduce my portfolio exposure into financial services, so that's the reason why I took that. And so overall, when I look at the diversification from an industry standpoint, the financial services and particularly banking will be reduced. As I mentioned in a previous video, my Barclays dividend was not paid by Free Trade. They eventually figured it out and they said that they weren't paid. So because they weren't paid by whoever they get the money from, the market maker or the bank or whoever, that's the reason why it was late for me. So I've eventually got it. But a good update for you guys to know. So I mentioned in the previous video that, the ex-dividend date is the date you need to have all your shares by for it to be counted for your dividend. Now, what transpired is that I bought 71 shares on the ex-dividend date and they weren't included. So after some back and forth with Free Trade, I learned that actually you need to have all of the shares bought the night before your ex-dividend date. So actually the close of the ex dividend date, almost, if that makes sense. So if your ex-dividend date is on the 20th, you need to have all of your shares bought by the 19th close. And then that way, even if you buy it on the 20th right at the open, it won't be counted. So that's just a tip for you guys if you want to sort of maximize your dividend payments. Now, the insurance sector is still looking really undervalued and has been performing well. So currently, the percentages you're seeing, all of my percentages right now have dropped just because I've funded £1,300 yesterday. So obviously, they were all much higher, but there's a reduction just because I'm buying at a higher price yesterday when I've done my previous round. So it looks like it's 3.5% for Aviva, and 4.5%, but they were in the 9 and 10s. Now, insurance is still looking undervalued. They're performing well. I will maintain my normal dollar cost averaging for the insurance sector. Currently, I've not been startled or had any reason to reduce how much I'm investing in both Aviva and Legal & General. So whilst they're performing well, I'll continue to maintain that and just keep the same strategy that I've had ever since the beginning. From a housing standpoint, I've been fortunate that, every time they've slightly dipped, I've bought at a good time. And as you can see, I've bought yesterday as well, and, 11.88% for Taylor Wimpey. So I'm about £100 there. It was a lot more at one stage, but it's kind of dropped, but that's fine. It should get up again. And Barrett, 13.91%. So again, 82 quid. So I'm doing well on housing. I'm really impressed with my housing stocks. I think if I was to sell any of my portfolio, it would actually be the housing stocks. Now, I know that sounds crazy just because they're performing well. But again, it is always good to collect your profits. You can, if your portfolio rises and you don't sort of, sell at the highs, what often happens is that it drops and then you sell at a low, and effectively then you haven't actually earned or maintained or got anything. Similar to what I've done previously with Man Group. It's a pattern that people get into consistently, that when it's in profit, they just think it's going to continue and stay and maintain and continue to grow. They don't collect those profits, it drops, and then they sell just to try and avoid too much losses. And in fact, then you only may potentially get, say, 20-30% of what you could have got. So I might sell them, but I will review it in terms of the value standpoint. I think the value was okay, but I would only really sell them if the market starts to shift downwards, if we start to get into a protracted bear market and we start to see that, Brexit or any form of recession or correction or whatever is coming to the economy, into the market, then banking and housing stocks will be the first to be affected. So for me, what I will do is sell those at that point, or try to preempt it and sell it beforehand, collect the profit and then put it into a bond, and a bond will tend to rise during a bear market period. So that'll be my strategy, but at the moment they're doing really well, so I'm currently happy with them, and at the moment it'll be BAU until something like that happens. Vodafone, meh, as you can see, 0.65 is a bit of a meh performance. Nothing much to be really said about Vodafone. Again, they're going to be the first mover advantage for 5G, so probably will buy more and wait for Vodafone to come up. Imperial Brands is still quite undervalued. It's been dropping recently, so as you can see, it's 0.70. It was about, say, 4%, 3%. It's kind of dropped, especially obviously I've just done a new purchase as well. It's quite expensive, so I don't buy much. As you can see, there's only 20 shares, just because it's like £25 a share, etc. Now, Centamin, where's Centamin? There you are. Centamin has shown me how logic can be superseded by emotion. I'm a scholar of the stock market. You know, I try and play by the rules. I know that you need to buy low, you need to sell high. I know that when stocks fall, that's when you have a buying opportunity and you buy more. I've exercised that approach with stocks in my current portfolio. You would have seen that in previous videos, and it's obviously benefited me. However, sentiment dropped 19% in the red. It was minus 19%. Really worried. Quite a few people messaged me on YouTube and also in the free trade community about, you know, being concerned with sentiment. So because of what happened with Man Group, I decided, you know what, I'm not going to buy more just in case sentiment is just going to crash. And obviously the Debenhams crash was happening at this time, and I sort of was a little bit worried, etc. I should have bought more. That was a mistake, and it's a mistake that I've learned from. I read articles even saying that sentiment is going to rise consistently during April, but it wasn't until sort of the last week that it actually started rising. As you can see, it's at minus 6%, including the fact that I've just done another round yesterday. So if I bought at, you know, minus 19%, I'd be comfortably in the green with sentiment. So again, if your stocks are falling, try not to panic, as difficult as it is. See it as a buying opportunity. Try and read as much as possible just to make sure it's not a Debenhams type situation. But if it's not, and it's just, you know, a current, you know, correction, or not a bear market, but you know, a bear period for that stock, then, you know, see it as a buying opportunity, because it really is. In terms of dividends, I've got 6 dividend payments coming in May and 1 in June. So that's the last of the dividend payments being expected. It's all of the stocks bar the new ones that I've bought, bar Barclays, bar Imperial and CYBG. So everything else, those are the dividend payments that I'll be expecting by the ones I just mentioned. And then I'll start looking at the ex-dividend dates for the next period, which will be around August, etc. And making sure that, you know, I try and build up as much shares as I possibly can to try and maximize those next dividends. But of this next set of dividend payments, I'll be expecting about £170, which is really good, during the end of May and just the slight beginning of June. And obviously, as you know, I'm about compounding. Check out my video on the power of compounding. I'm just going to reinvest that money. No way will I sort of withdraw that or try and spend that money. That money is just to be reinvested. That money, you know, caters for, you know, £170 in dividends, covers this £6.34 loss right here. It covers this £3.41 loss right here, and it also covers, you know, this £30 loss right here, probably by, I say, 4 times. So, you know, it's 4 times. Those dividend payments alone are 4 times any losses that you can currently see in this portfolio. That's why the power of dividends really does protect you against any loss in growth in your portfolio. Having a diversified portfolio really means that, you know, you can really benefit in some areas, and it really counteracts any losses in other areas and makes them sort of less, you know, less worrisome, probably is the best way to put it. But yeah, that's the portfolio update for today. I will try to do them weekly, but to be honest, I'd rather not set it as a specific time weekly, but rather when there's actually some valuable information to give you guys. So if there's anything valuable in my portfolio, then, you know, I will definitely do a portfolio update. Other than that, I will try and make sure that I don't keep it too long, maybe this sort of week to 10 days mark. But, you know, we shall see. But if you're new to this video and, you know, this is your first introduction to Infinite Investors, this channel is about helping all new and non-investors make sense of the stock market through a variety of means, whether it's stock market news, whether it's my own portfolio update, as you can see here, whether it's different types of strategies, or information about the stock market, or things like compounding interest, as a video I've just put up, or what type of investor are you, and tips and tricks, and a whole heap of stuff, even fundamental data, etc., etc. So if you want to know about the stock market, if you want to get clean, transparent, simple information that's not laden with jargon, that's not clickbaity, that's not going to be sort of false information, then this is your home. And please subscribe to the channel. I'd love to have you on board. Leave me any comments, and I'll always try and get back to you as quickly as I possibly can. But other than that, guys, I've bored you enough. Have a great weekend. Enjoy your weekend. And I wish you all of the best with your portfolios. If there's any questions, please get in the comments. Please share the video as well, so that the channel grows. I'm trying to get to 500 subscribers, and yeah, any help would be appreciated. But other than that, have a great day, and last but not least, happy investing. Take care, guys.